All right, let's just dive right into this explainer and learn how you can confidently navigate what is arguably the biggest emerging market of our generation. Welcome, everyone. Today, we're unpacking a comprehensive playbook for entering the world of cryptocurrency, and we're sourcing this directly from the top strategies being used by the pros right now. Look, we know that 99% of people get completely overwhelmed by the complex jargon, the crazy volatile charts, and all the technical barriers. It's a lot. But today, we're going to empower you. We're going to give you the precise tools you need to become part of the 1% who skips the panic, takes calm, informed action, and actually secures their digital wealth for the future.
So here is our exact step-by-step roadmap for today. We'll kick things off with why invest, then move into learn the vocabulary, analyze the market, choose your strategy, and finally wrap up with buy and secure.
All right, step 1, why invest in the first place?
Think about this for a second. $100 back in the year 1900 only has the buying power of about $3 today. $3. That's the harsh, unavoidable reality of fiat debasement. Unless you've got a time machine hiding somewhere, holding cash means you're basically guaranteed to lose purchasing power over time. As governments endlessly print more money, they dilute the supply and quietly erode the value of the cash sitting in your pocket.
Now, when you compare the alternatives, Bitcoin fundamentally outperforms both traditional money and gold in almost every single critical category. Traditional money? Highly centralized. Gold? It's heavy and incredibly hard to move around. Bitcoin, on the other hand, is 100% decentralized. It is strictly scarce, with a maximum supply of exactly 21 million coins. No more can ever exist, and it's instantly portable across the globe. It really acts as the ultimate digital hedge against inflation.
Moving right along to step 2, let's learn the vocabulary.
First up, we've got tokenomics and FDV, which stands for fully diluted value. Tokenomics is basically the study of a cryptocurrency's economic design. And FDV? That's the total market cap if every possible token were actually out there in circulation. You absolutely have to look at a project's tokenomics and FDV to avoid dilution. Dilution is when way too many new tokens suddenly flood the market and just completely crush the value of the coins you're already holding.
Next up is a term you're going to see absolutely everywhere. HODL. Legend actually says this started as a drunken typo in a frantic crypto forum post way back in 2013, but it's since become this legendary acronym for hold on for dear life. When the market gets super volatile and crashes into bearish territory, HODL is just the simple, steadfast philosophy of weathering the storm instead of panic selling your bags.
Okay, then we have the fiat on-ramp. You can kind of think of this as a digital toll booth. It's a service that lets you swap your traditional government-issued money, like US dollars, for cryptocurrency. To get into the ecosystem at all, you absolutely need a fiat on-ramp to push your hard cash onto the blockchain.
Now, where do you actually trade once your money is in? You have centralized exchanges, or CXs, like Coinbase or Binance. They act as middlemen and are incredibly easy for beginners. But remember, they hold your private keys. Then you've got decentralized exchanges, or DEXs, accessed via tools like MetaMask or Phantom. These give you true peer-to-peer freedom, where you hold your own private keys and don't rely on any central entity. Like the golden rule of crypto says, not your keys, not your coins.
Which brings us to step 3, analyze the market.
If you want to find where the smart money is moving, you need a solid detective toolkit. You've got CoinMarketCap for your fundamental metrics and token supplies. Then there's DeFi Llama, great for tracking total value locked, or TVL, to see where real money is actually being put to work across different blockchains. MarketCap is a fantastic tool that lets you realistically gauge growth potential between tokens. And of course, TradingView is your go-to for technical charting, like drawing trend lines and Fibonacci retracements. Together, these 4 platforms are your ultimate research hub. You want to check these out before you risk a single dollar.
Let's put that data into perspective. If you compare the massive $21 billion peak of Binance Smart Chain's total value locked to a newer protocol like Base, which was recently sitting around $1.6 billion, you can instantly spot massive upside potential before the rest of the market even catches on. Finding early protocols with plenty of room to grow, that is how fortunes are made.
Now, if you're looking for a dead simple way to time your Bitcoin investments without staring at screens all day, try this. Step 1, open up TradingView. Step 2, add the BTC mining cost indicator. You want to buy when the price drops near that line. And step 3, add the terminal price indicator. That's your signal to sell when the price hits that peak. Historically speaking, buying near the computational cost of mining and selling near the terminal price has generated some pretty incredible compounding returns.
All right, step 4, choose your strategy.
You've essentially got 4 distinct paths to choose from here, and you really need to pick what fits your lifestyle and risk tolerance. Path 1, you can safely hodl long-term. Path 2, you can stake your coins to earn a steady annual yield, treating it a bit like a high-interest savings account. Path 3, you can auto-invest, which means letting a machine automatically buy a fixed dollar amount for you every single week. Or Path 4, you can embrace higher risk with short-term trading, using leverage on platforms like Bybit for rapid market moves. Whatever your style is, there's absolutely a strategy here for you.
Keep in mind, the strategy you pick is going to have a major impact on your taxes. Short-term trading, meaning you hold an asset for under 365 days, usually gets hit with a pretty high tax rate that's tied directly to your income bracket. But if you practice a little patience and invest long-term for over a calendar year, you benefit from significantly lower long-term capital gains taxes. So yeah, patience literally pays off.
And finally, step 5, buy and secure. It's time to actually pull the trigger, make your purchase, and lock your digital wealth in a vault.
So here is your execution playbook. Step 1, move your fiat over to a centralized exchange like Coinbase. Step 2, swap those US dollars for a stablecoin or whatever crypto asset you're after. And step 3, transfer your long-term holds completely off the exchange to an offline hardware wallet. This 3-step flow is the exact crawl, walk, run progression every single investor should be using to securely move their cash onto the blockchain.
Let's quickly clarify what a hardware wallet, or cold storage, actually is. It's a physical device, kind of like a ledger thumb drive, that holds your private keys completely offline. Look, keeping your coins on an exchange is fine for a little while, but moving them to cold storage means nobody, no hacker, no shady exchange, no government can touch your wealth without physically possessing that exact device. It makes you practically hack-proof.
One absolutely vital piece of advice for this execution phase: you've got to stay organized. Before you go wild and execute a dozen trades across multiple wallets, do yourself a huge favor and set up automated tracking software like CoinTracker. You want it logging your profit, your loss, and your fees right from day one. You definitely do not want to be drowning in confusing paperwork and frantic calculations when tax season inevitably rolls around.
Well, we have covered a tremendous amount of ground today. You've got the playbook, you know the vocabulary, and you've seen the strategies. So, as you look to protect yourself from currency debasement and really tap into this massive emerging market, I'll leave you with this question: what action will you take today to join the 1%?
Welcome to the Ultimate Explainer. Today, we're stripping away the hype and cutting straight through the absolute noise of the modern crypto market. Look, if you've been feeling totally overwhelmed by conflicting info, rugged by bad projects, or just dizzy from wild price predictions, well, you're exactly where you need to be. We're delivering a completely data-backed masterclass to help you navigate these digital waters like an absolute veteran. Here's the roadmap for today's explainer. We're covering 1. The crypto foundation, 2. Wallets and security, 3. Reading the market, 4. The pro-investor mindset, and finally, 5. Building your portfolio. So let's jump right in. The crypto foundation. So if you're frustrated that the US dollar has literally lost over 23% of its purchasing power in just the past 5 years, crypto is your transparent hedge against that. But you absolutely must understand the foundation first, and that starts with your seed phrase. Listen, this isn't just some password you can reset. It is a 12 to 24-word human-readable master key. It grants total, completely unrestricted access to all of your crypto accounts on the blockchain. If you lose this, there is no forgot password button to save you. And if someone else finds it, they can and will drain your accounts in seconds. Think of this as the ultimate physical key to your digital vault. Next up, we've got smart contracts. Now, this right here is the actual engine of decentralized finance. A smart contract is simply self-executing code living right on the blockchain. It automatically performs an action, like swapping one asset for another, but only when very specific conditions are met. What's the magic here? It entirely removes the human middleman. There's no bank teller, no broker, no corporate middle manager who needs to stamp a form to approve your transaction. It makes the entire financial ecosystem trustless and just wildly efficient. Now, it's absolutely crucial to understand the difference between coins and tokens. People mix this up all the time. Coins, think Bitcoin or Ethereum, are the native currencies to their specific blockchain network. They actually pay for that network's transaction fees.
Tokens, on the other hand, live on top of an existing network. This includes stuff like meme coins. And look, even though they usually feature a really cute dog, meme coins are incredibly speculative. Honestly, you need to treat them less like traditional investments and way more like casino chips. They're driven by internet culture and hype, not by deep technical utility.
All right, moving on to part 2, wallets and security. We're shifting gears into risk management right now. Because, let's be real, making $1 million in crypto means absolutely zero if you can't actually keep it safe. So there is a massive difference between custodial wallets, like your big exchanges, Coinbase or Kraken, and non-custodial wallets, specifically cold storage. Now, exchanges are super convenient for buying and selling, sure, but they hold your keys. And there's an old saying in crypto, not your keys, not your crypto. If that exchange suddenly goes bankrupt or they just decide to freeze your account for a random security review, guess what? You are locked out of your own money. To take full, true ownership, you have to move your assets to a non-custodial hardware wallet and keep those keys entirely offline. The stakes here are just incredibly high. $40 billion. Let that sink in. That is the staggering amount of cryptocurrency lost to scams and hacks in 2024 alone. We're talking about over 1% of the entire global crypto market cap just wiped out in a single year. And please don't think this only happens to massive corporations or sloppy institutions. Tens of thousands of everyday retail investors fall victim to these criminals all the time. Let's actually walk through the exact scammer playbook for what we call a rug pull. Step 1. Scammers create a brand new token that has literally zero real value. Step 2. They deploy trading bots to artificially inflate the price and fabricate trading volume, making it look like it's the next big thing. Step 3. All that fake momentum attracts excited retail investors who are just suffering from massive FOMO. And then, step 4, the trap springs. Once the liquidity pools are stuffed with real retail cash, the creators sell off their massive hidden holdings, drain the entire pool, and just disappear into the night. And you're left holding a totally worthless token. But honestly, the most dangerous threat to a smart investor is a malicious contract approval. You should never, ever connect your main cold storage wallet to some random website just to claim a free airdrop or mint a shiny new NFT. Why? Because when you click connect, you're actually signing a spend approval. If that smart contract is written maliciously, signing that approval gives a scammer permission to instantly drain your entire wallet. The pro move here, always use a separate temporary hot wallet when you're interacting with new websites. Okay, part 3, reading the market. Now that your digital vault is securely locked down, let's shift to offense. To actually navigate this wild volatility, we track the historical 4-year Bitcoin cycle. It always kicks off with a halving event, which is exactly when the new supply of Bitcoin getting mined gets cut right in half. Now, historically, the market peaks exactly 532 days after that halving event. After we hit that euphoric peak, we plunge into a brutal 80% drawdown phase, which is then followed by a really long, boring period of consolidation. Grounding yourself in this chronological reality, that is what protects you from getting swept up in this crazy emotional day-to-day price swings. Surviving this cycle requires a true contrarian expert mindset. See, retail excitement means buying when Google's search volumes for crypto are spiking and literally everyone at the grocery store is talking about it. But historically, that is the exact top of the market, right before a massive crash. The pro investor does the exact opposite. You have to buy the fear, you accumulate when the market search volume is totally dead, when it honestly feels kind of stupid to buy. And then, you sell your bags when the general public is getting wildly, irrationally excited. Beyond just the halving, we also track massive macroeconomic catalysts that trigger sudden market liquidity. For instance, interest rate cuts historically inject a ton of capital into risk-on assets, exactly like crypto. We also see a massive, almost historical certainty around U.S. midterm elections. Markets absolutely hate uncertainty, right? So when midterms pass and the political agenda is finally locked in, markets historically see an average 15.4% return the following year. And functionally, right now, we're watching the explosive rise of AI agent tokens, which are completely bridging artificial intelligence and blockchain utility. Part 4, the pro-investor mindset. If you want to actually execute a long-term wealth strategy, instead of just gambling for quick, stressful little flips, you need the right mental framework. Just look at Bitcoin's historical compound annual growth rate, or CAGR. It is over 50%. Even if we model that out to a much more conservative 20 to 26% moving forward into the coming decades, it still absolutely crushes traditional equities, which usually sit around 10%, and real estate around 7%. We are literally talking about a potentially once-in-a-generation asymmetric upside here. Think about it like this. If you start with a base investment of just $1,000 and you consistently add just a few $100s a month, the power of compound interest in the crypto market is frankly staggering. Because of those higher growth rates we just talked about, that super modest monthly investment compounding over a couple of decades can literally explode into a multi-million-dollar portfolio. It far, far outpaces the final returns of making those exact same investments in standard stock indices or traditional real estate.
But here is the catch. You have to pick the right assets to compound. I absolutely love this quote. Don't buy promises, buy products. Look, a massive mistake beginners make is investing based on a really shiny roadmap of what a project might do in 5 years. Don't do that. Smart investors look at actual utility. Does this blockchain have real users today? Is there actual total value locked in its decentralized finance protocols right now? You have to invest based on fundamentals that actually exist today, not a pipe dream for tomorrow.
And finally, part 5, building your portfolio.
All right, let's bring all this data, security theory, and market analysis together into a real, actionable strategy. This is exactly how you balance conservative wealth building with massive speculative upside. We highly recommend isolating 75% of your investment capital into a core portfolio. This consists of your bedrock majors. We're talking primarily Bitcoin and perhaps Ethereum. This is your slow and steady wealth builder that you continuously add to and rarely, if ever, sell. Then that remaining 25%, that gets allocated to the casino portfolio, and that is reserved strictly for those asymmetric, high-risk bets where the truly massive gains happen. So what actually goes into that 25% casino portfolio? Well, this targets much smaller market cap projects. We're talking brand new token launches, highly speculative meme coins, and cutting-edge AI agent protocols. But the absolute secret sauce here is that you only build this portfolio during dead times in the market, when no one else is paying attention. And crucially, you must have incredibly strict take-profit rules. You are not marrying these altcoins. You use the euphoric peak of the Bitcoin cycle as your clear signal to sell these risky assets and actually lock in your gains.
Which leaves us with this final, provocative question. We've stripped away the hype today. You've now got the data, the security protocols, the cycle timelines, and the exact portfolio structure. The financial opportunity here is absolutely massive, but actually executing it? That requires flipping standard human psychology totally on its head. So do you actually have the discipline to execute this playbook? Buy the fear, secure your keys offline, and survive the next crypto cycle. Take these insights, refine your strategy, and I will catch you in the next explainer.